Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about the hypothesis that banning negative gearing will actually force you to become a better property investor, or will force people to really think more carefully about property investment, more correctly. So unless you've been living under a rock, you will realise that the Labor Party has suggested they'll ban negative gearing on any newly purchased established properties, so it doesn't apply to existing investments, after a yet-to-be-determined date. And that they will ban negative gearing in respect to those properties. And obviously, if you don't get negative gearing benefits, then the cash flow cost to hold a property is going to be a lot higher than what it is today with negative gearing benefits, because you don't get that tax break. And so my hypothesis is that I think if this goes ahead, well, if Labor wins and Labor gets the policy introduced as proposed, I think it's going to force people to become better property investors. So, too many people are, I think, persuaded or seduced by tax benefits. And there's really two tax benefits that are key with respect to property investment. And the problem with being persuaded by tax benefits is that the tax benefits will one day evaporate, will dry up. Tax benefits aren't perpetual, whereas the quality of an asset is perpetual. The quality of an asset very rarely changes. It can, but it very rarely changes with property. And if it does change, it will take many, many decades. But putting that aside, that's rare. The quality of your asset will not change, but the tax consequences will over time. And that's because of the nature of the asset. And as the asset grows, it will produce more income, so there won't be a loss. So fundamentally, the proponents of return will change. But also, obviously, tax rules and legislation and so forth will change over the time of ownership too. So my advice would be to really focus on the fundamentals of the asset, and then the tax outcomes are really just a consequence of that investment, are not the reasons for that investment. Now that's my advice, but my observation over the last 16, 17 years is distinctly different, that people are seduced by tax benefits. And the reason they're seduced by tax benefits is because people are very short-sighted. People tend to think about the next 1 or 2 years rather than the next 1 or 2 decades when making financial decisions. So there's two key tax benefits with respect to property that are widely promoted. The first one's depreciation benefits, and obviously depreciation is a measure of a dwelling's reduction in value over time. So the dwelling's part, the building component of the property, not the obviously land component of the property. And if you go and buy a new build property, the depreciation will be significant over the first decade of ownership. A little bit like when you go buy a brand new car, they say when you drive it off the lot, it immediately depreciates by 10%. You've lost 10% of value, bang, like that. Well, very similar with property. You've got a shiny brand new property. You've probably paid a lot more for building value than you have land value, and that building value will depreciate considerably over the next 10 years. And in 10 years' time, based on how the quality of the average built property today, in 10 years' time, you'll have to end up spending a lot on maintenance and so forth just to keep it looking serviceable. And so the problem with depreciation is obviously then you need the land value to appreciate in dollar terms by as much as the depreciation to at least offset that reduction in value. And then you want it to obviously appreciate by more, so the overall value of the asset is increasing. That's unlikely with a new build property because you don't have a big enough land value component. So, if you've spent $1 million and you've only got a $100,000 land value component and that property is depreciating, that land value component has to triple in value, for example, over the first couple of years, just to even provide you a very modest overall return. And, if you're investing on the hope that land will triple in value in a very relatively short period of time, I think you're making a poor assumption. The second one is negative gearing, obviously, and that just allows us to offset any losses that we make with our investment against other income, so our salary income, and reduce our overall tax payable. So really, depending on what marginal tax rate we are at, we'll get that level of tax break. So if we're on 39%, 39% of our loss will be funded through a reduction in taxes, and so we only have to pick up really 60% of the gross or the net pre-tax loss of a property. Now, the problem with negative gearing is that you're losing money, right? That just the mere fact that you've got negative gearing benefit is that because you've lost money. And the only reason you'd lose money is that you hope to pick it up on the other end. So from a capital growth perspective. And probably the best example is in the stock market is Amazon, for example. So today Amazon's worth 830 billion US dollars, so over $1 trillion Aussie dollars. However, it makes, in terms of profit, about 3 billion US dollars a year. So, I mean, $3 billion is a lot of money, but not for a company that's worth $830 billion. But more than that, it's negative cash flow. It burns more cash flow than it makes, and it's never paid a dividend. So clearly, if you're buying Amazon shares, you aren't buying for income. You're buying on the hope that that it's going to be worth a lot more in the future. Well, it's already worth 104 times earnings, so I'm not sure whether I believe it will be worth more in the future. But anyway, that's a different conversation for another day. The same concept, however, applies to property investment. If you're going to make a property investment and you're going to lose $10,000 a year in terms of after-tax income just because you're funding that investment, you absolutely want to be rewarded for that fact or compensated for that fact through, in the long run, a good level of capital growth. So you want to make sure that $10,000 expense per year will be, in 20 years' time, completely immaterial. You know, you look at that and you go, that's nothing compared to the equity they'll have in the property. So that's why I think you'll have to be, or investors will have to be, you're forced to be more picky in the future if we don't have negative gearing, because the cash flow cost of a property will be a lot higher, and we'll have to then really prudently look at and say, okay, if I'm going to lose, instead of $10,000, it's going to be $15,000 a year because I don't have a negative gearing, I really want to be as certain as possible, almost virtually certain, that in the long run, I'm investing in such a quality property that I'm going to be well rewarded for that fact. And I've done some analysis, and over a 20-year period, you need a capital growth rate of about 0.4% higher than what you'd need today with negative gearing. So therefore, we need, let's just call it 0.5%. We need 0.5% more capital growth to compensate us for the fact or the possibility that we won't have negative gearing in the future. So therefore, you absolutely have to nail asset selection. Now, I think that's the case with or without negative gearing, but if we're not going to have those tax benefits and the cash flow cost to hold property is increased, then we really need to have a heightened focus on the quality of the assets. So how do you do that? Well, you stick to the fundamentals, and I've got a link to the blog in the show notes, which outlines the 3 core fundamentals that I believe all investment-grade property must have. The first one is that it's got to have a strong land value component. Land appreciates, building depreciate, and it's land that we as investors are interested in. The dwelling is the tenant will be mostly interested in and will dictate its income, but we don't really care about the dwelling. We're happy to have really a basic dwelling on a land just to generate some rental income, as long as that land is located in an area that's fantastic. So you want more than 50% of the overall property value to be representing land value. The second thing is you want scarcity. So you want the land to be located in a location that it has a very finite supply of land, and hopefully there's actually no supply of vacant land. So really within a sort of 20 to 30 minute drive, you shouldn't be able to find, or at least vacant land is incredibly scarce. Now, in new build areas, you'll drive 10 minutes, 5 minutes or around the block and you'll find lots of vacant land. That doesn't create scarcity, and that then doesn't position us to necessarily enjoy a lot of capital growth. Secondly, you want the land to be located in an area that's in high demand. So you want to then consider, the schools, shops, medical facilities, parks, public transport, arterial roads, all those sorts of amenities that make an area very livable for not only owner-occupiers but tenants. Thirdly, you want that area to be dominated by owner-occupiers, not investors. So again, inner city high-rise apartment areas, they tend to be dominated by investor owners, and there's a lot of renters in there. You don't want to be invested in that sort of market. And lastly, you want the architecture of the property you're buying to be scarce also, because that creates that sort of scarcity element. So first one, strong land value component. Second one, scarcity. The third one is, and this is a core tenet of evidence-based investing, and an evidence-based investing approach means that you only invest if there's overwhelming evidence that demonstrates that you'll achieve good outcomes. And so the third one is that the property must have demonstrated its capacity to generate strong capital growth over the long run. So therefore, if you have a look at its past sales over the past 2, 3 or 4 decades, and you calculate a compounding capital growth rate over that sort of period of time, it builds a strong picture of strong capital growth. If it doesn't have a strong history of capital growth, my argument would be, why take the risk? Because what you're sort of suggesting is that the future, or the past won't repeat itself, that the future will be different to what the past will be. Well, you want to have a really strong reason for ignoring the history of a performance. So they're the three things. Investing in investment grade property will put you in a good position to more than offset the loss of negative gearing if it occurs in the future. Now, I'll leave you by reminding you the two key reasons I think it's smart for people to invest in direct property. Now, I'm not saying everyone should invest in direct property. It depends on your situation, your goals, and all these sorts of things. But if you're in a position where you've got a relatively small asset base and your goal is to grow that asset base, because as I've spoken about before, building wealth or retirement takes 2 steps. First one, grow your asset base. Then secondly, grow your passive investment income. You can't start off by growing your passive investment income if you don't have a strong asset base. So if you need to grow your asset base, so if you're in your 20s, 30s and 40s or even 50s and you're some way away from retirement and that's what you need to do, I believe property investment is a great way to do that. And there's 2 key reasons for that. The first one is that investment grade property provides most of its return in capital growth, not income. Whereas with the share market, if your overall return is, say, 10%, then you're going to get sort of 4.5% of income, and you're going to get 5.5% to 6% of capital growth. Whereas with property, again, if you're assuming the long-term returns are 10%, and they are, then you're probably going to get, after expenses, net income of around 2%, and you'll hopefully get capital growth of around 8%. Well, that's what it's been. Well, it's been well above that in many areas over the last 30 to 40 years, but let's be conservative, and that's what you're going to get. So less income, more growth is much better because you don't have to pay tax on the income. You pay tax on the income every year, but not on the capital growth. And you then benefit from that compounding capital growth. The second reason is that most people feel more comfortable borrowing to invest in property than they do shares. So most people are quite comfortable to go out and borrow $500,000 and invest in property, whereas they'd feel relatively uncomfortable to go and borrow $500,000 and invest in shares. And they're the 2 fundamental reasons why property, if, again, your goal is to build your asset base, is a good investment. You see, I've mentioned nothing about negative gearing. So negative gearing is merely a consequence of that investment decision rather than a reason for it. And that's why I don't think negative gearing is really going to change whether investing in property is good or bad. It's really just going to have a heightened focus on really the asset quality to make sure you're more than compensated for the higher holding costs. Of course, if you're getting close to retirement and building around, and you've already got a strong asset base, then quite possibly investing in property isn't the right thing for you to do. Okay, I hope that's been worthwhile. As always, there's more information and links in the show notes if you need more information. Obviously, a blog on our website. If you're enjoying the podcast, please do share or leave a rating on iTunes. That would be of great assistance. And until next week, bye for now.